Everybody, it's Mike McGinnis over at Landmark Realty. I got a special series today. I have a special guest coming on today. His name is Mike Scarimbolo from First Home Mortgage. I'm sure you've been hearing a lot about mortgage forbearance. I'm not sure you're aware that there's new regulations with FHA as far as borrowing and getting a mortgage. And also be interesting to look at those interest rates today. So without further ado, I'd like to introduce to you a special guest that we have today, and it's Mike Scarimbolo of First Home Mortgage. Been in the business over 17 years. He's licensed in in all 50 states. Puts out a newsletter, which is very informative, very helpful guy. So if you have any questions or information, he's the person to talk to. So without further ado, I'd like to introduce to you Michael Scarimbolo. All right, so without further ado, we're introducing Mike Scarimbolo from First Home Mortgage. Mike, thank you very much for coming to meet me. There's been a lot of talk about things. I read one of your recent updates where you're talking like it continues to increase for mortgage forbearance.
Yeah.
I said it's like up to almost $4 trillion across the four major lending institutions. So
Yeah.
it seems like it's a lot of concern, and something I think people are confused about. They think it's a free ride. They think they don't have to pay their mortgage or repay it back. So if you can just elaborate, first explain what is mortgage forbearance, and also if you can give us the pitfalls, what to do, what not to do, and just give us some safeguards.
Yeah, no, sure. Mike, thanks for having me, and glad to help and put the information out there to the public so that everyone could understand what's going on. So part of the forbearance obviously is for, the government to step in to help individuals during this time while there may be loss of job or lack of income coming in, to help them, forego mortgage payments for the next 3 months. Since this happened, some time ago, the thought process was April, May, and June. For some individuals, could be May, June, and July.
Right.
And the forbearance, what they're doing is allowing you not to make mortgage payments during this 3-month period. And after 3 months, it all depends on the lending institution, if they will allow you to make one lump sum payment for 4 months all in one shot, right? So you have the 3 months that you skipped, along with the next month that's due. So there's some lending institutions are asking for that lump sum of money. Other lending institutions are allowing you to spread that or put that to the back of the loan. Each lender is somewhat different here, and that's what we're finding out. There are a multitude of lending institutions. Some have better liquidity than others. And by that, some of them want the money up front. Some are allowing you to stretch it out over the back end of the mortgage. So you do have to do your own due diligence to find out exactly what your lender is allowing you to do. The other half of it too, Mike, is the concern really is okay, so I don't make my mortgage payment. What about my credit, right? Credit could be some sort of an issue. At first, we heard a lot of lending institutions stating that they weren't going to mark you late. I personally got a letter. I'm not going with my forbearance. I just want to see what was going on. You're in the business, you want to know. And my lending institution that I pay my mortgage to told me if I don't make my mortgage payments during this period, could report late on your credit report. And that's a problem. I have really good credit. I upkeep that very well. I don't want to hurt my credit score. One mortgage late on your credit brings your credit score down at 25, 50 points in that range. So you don't want to start having, 3 lates in a row, God forbid.
Right. So let me ask you this. So now that's if you're late on your regular conventional mortgage, but what if you apply? You're saying, I want to apply for forbearance. Mm-hmm. You're saying that it's considered a missed payment anyway, and it could affect your credit score.
So that's the hesitation on my end, because this is new for everybody. COVID-19 never happened to any of us in our lives before. So not only is it new for myself and yourself in the industry, in real estate and mortgage specifically, it's new for the President of the United States. It's new for the lending institutions specifically, right? So at the end of the day, we just don't know yet. So what my concern is, and what I want to put out there to everybody, is this. If the lending institution that you're with is saying that they're not going to mark you late during your forbearance, then just get that in writing, so that when you have it and, and they do mark you late for any particular reason, you have this piece of paper that stated, No, you told me I wasn't going to be late. Do you think lenders are going to make mistakes marking people late when they shouldn't be? Normal times prior to COVID-19, Michael, normal times, if you're late, if you do go into a forbearance, because you
Right.
could have done this prior to COVID-19 and you didn't make payments, the fiduciary responsibility of that lending institution is to mark you late. So the normal policies and procedures that are in place prior to this were to mark you late. Now the government's saying you can't mark anybody late during this time. So could mistakes happen? I just want everyone out there just to
Well,
make
that's
sure.
an automated process, correct? A lot of it's set up automatically. So
Absolutely.
they have to remember to go in there to change that parameter so it doesn't mark you late.
Right. It just,
Uh,
trust but verify, right? That's
yes.
basically it.
Yes. Okay. No, I got it. So now, I mean, I'm not me personally, but let's say a scenario
Mhm.
that there's a person, he's out of work. He really is in dire needs of, he's not able to make his mortgage. He doesn't want to lose his house. What's the best way? And obviously, you already gave us some good advice to check with your lending institution.
Mhm.
What other things should we watch out for? What should this person do that
Yes.
is
So
considering
the one
forbearance?
thing I was saying, great point, Mike, great question. So the one thing I was saying previously is if you don't need a forbearance, don't just apply for the forbearance because everyone else is doing it, right? You're going to put a big stress in the mortgage industry and a big stress on the lending institutions that are out there.
Right.
The forbearance really should have been for those individuals that loss of job, loss of income, reduction in income, right? There's the hardship. So if in fact your scenario that you brought up, Michael, if the individual is not working right now, can't make his mortgage payment, or she can't make her mortgage payment, and not receiving any income right now, laid off, or small business owner. Geez, I feel terrible
Yeah,
for a lot of
really.
those small business owners, but small business owner that the doors can't open right now because of the quarantine, the mandated quarantine. Yes, call your lending institution, get the forbearance started. It's going to take a couple days before it gets approved. Once approved, you're going to be in that process. Get everything in writing, like I was saying to you previously, Michael. Make sure you have it all in writing, whether it's email or paper format, and start that process. And then if they want the money, the whole 4 months in one shot, Michael, what I would suggest those individuals do that are not working, renegotiate with these lending
Hmm.
institutions. Let
Okay.
them know, hey, listen, I know my 3 months is up. I owe the four all in one shot. I'm still not operating. I'm still on unemployment. I still cannot make my mortgage payment.
Great
Please, let's
point.
try to renegotiate this down the road for somewhere down the road, whether it's 12 months or at the back end of the mortgage, whatever it may be.
Because it's an advantage for them not to lose this customer,
Absolutely,
because
Mike.
then it goes into foreclosure, which is a whole nother other problem. So even though they say he's due in 4 months, that's a great point, Mike. It's
Mhm.
excellent point. So you see, it's not a free ride,
No,
and you want to be careful before you just go ahead and take forbearance. Take
absolutely.
his advice.
Yeah.
Now, other things that I've been hearing around the market is that the FHA has new standards for people to apply for mortgages and loans. So what's going on with that part of the market?
Yeah. So, yeah, again, good topic of conversation. There have been some changes industry wide, right, for mortgage financing in general. So, I'm going to talk about two different scenarios. One are the conventional loans, which is Fannie Mae, Freddie Mac, and the other is the government loans, which is FHA and VA. And I'll start there because you started with that question. So, FHA and VA, you're seeing the biggest change out of the two, if you want to call it conventional or government loan. So on the government loan, you're seeing more changes, and I'll articulate what they are. So credit score criteria used to be able to go down to a 580 FICO score across the board. A lot of lenders, including mine, have increased that FICO criteria to now a 660 FICO score. So
660.
660, 660,
Wow,
big jump.
that's a big jump.
Yeah. And I'll get into the big jump in a second. Other than
Okay.
that, they also have to have, they being the client, has to have 3 months of reserves in the bank. So that's 3 months of principal, interest, taxes, insurance payment in the bank after you close. They want to make sure you still have 3 months of those reserves in the bank, where previously you didn't need to have that. And
If I may, you're talking that's on top of the down payment. I mean, at one time it used to be you just can you make the down payment, you're good. you're saying now you have to make the down payment plus have that reserve?
And Michael, don't forget down payment and closing costs, right? So down payment, closing costs, and now you have to have these 3 months reserves in the bank. So it's more money that the client has to have to purchase a home in this very time. You can get a gift still with FHA and VA, but they won't allow the reserves to be a gift. So you can get a gift at a down payment and the closing cost, but then you have to have your own reserves. And what could reserves be? Just to be clear to your viewers out there, the reserves can be money in checking or savings, any life insurance policy with a cash value, or for the most part, any sort of retirement, 401k, IRA, something like that. You could use those investment vehicles as reserve money. So,
Okay, so what's the time frame on that? How long does it have to be in your checking account, savings account, when it's considered reserves as opposed to a gift?
well, that's a horse of another color, if you want to say, because you know theoretically they want to see it in there 60 days, but if someone had sourceable deposits, Michael, and they got a $10,000 deposit yesterday and they put it into the bank, we would be able to use it as long as it's sourceable. So the true answer is 60 days is the norm, if you want to say.
Right.
But one other thing I want to bring up with the FHA and VA, which is kind of important, the qualification for FHA and VA shrunk a little bit. And what do I mean by
Okay.
that? FHA and VA allowed you to go to a 56.99 debt to income ratio. They have theoretically still have come down on that debt to income ratio down to a 50%. So that 6.99%, as much as it doesn't sound like a lot, right? It's 6.99. It actually brings down the qualifying borrowers, what they're able to qualify for, I should say, for a mortgage. It does bring that dollar amount down in terms of purchase price or borrowed amount. So there was if you want to
Okay.
say out of the two institutions, conventional and government, there was a heavier change in the government loans.
So now buyers have to be careful how much outstanding debt they have,
Correct.
because now it's down to like 50%, you said,
Right. Mhm.
where before it was almost like a 60-40.
Yeah, I'll be close to it, 56.99. But
Right,
yeah, but at the end of the
56.99,
day, you're
right.
right.
I rounded it off, but
Yeah,
yes, right.
understood.
You did
Yeah,
say 6.99.
yeah.
I'm being general. I'm being the general guy. You're the
I hear you.
professional.
I hear you.
Yes. Yeah. So this is great information. Now, what is the interest rates? Everybody wants to know what the interest rates are. So what's going on with the market today?
Yeah, interest rates are still great. I mean, we had one of these, and it came down back to life. And when I say this, this is March 2nd, and it
Okay.
started to climb up by like March 10th, and then that's the height of COVID, and then we've seen it come back down around. So let's talk what interest rates look like, so everyone could understand, because they could have called somebody a month ago and say, "Oh, I heard rates went up." Well, they did. So we are now in the middle of May, and they have leveled off, so to speak. So on a 30-year fixed, single family, primary residence with 20% down, excellent credit. And by excellent credit, we're talking about a 740 FICO score and above. You're looking at 3.25% 30-year fixed rate on
Nice.
a 15-year fixed, maybe at like 2.75. So the
Is that
rates
with
are really
points? No points? Or is that
no
with,
points involved. No, none at all for those two, scenarios I just gave you. You could always buy down your rate, Michael. So great point. You can pay points to buy down the rate further, but no points involved at that 3.25 30-year fixed. Multifamily is probably 3.3 to 3.5. So that's 2 to 4 family residents. So interest rates are relatively good. Matter of fact, they're great. It's not even relatively good. I mean, that low we haven't seen in quite some time.
so what's the range, for existing homeowners who have an outstanding mortgage? What's the range at which you say, yeah, it's now worth it to refinance as opposed to not?
Fantastic question. So the rule of thumb in New York City, and I'll stick with New York City for the second, 5 boroughs of New York City specifically for the second, we pay mortgage tax here, right? So the mortgage tax is 1.8% under 500,000, 1.9% over 500,000. So it's costly.
Right.
There's a process that we can do to save you money on the mortgage tax through the city of New York and through the lending institution you're with, but I don't want to get into all that. The rule of thumb would be if you could save almost 1%, if not 1% in your interest rate, it's worth it to refi. So if you're at 4.25 or higher, it would be advantageous to refinance to definitively from a 30-year to a 30-year. Definitely, there's no doubt about that. Where it would really be advantageous if you went from a 30-year to a 20-year, and then you're saving a ton of interest payments and reducing the life of the loan or how many years you have to pay it back. So I have a lot of clients going from 30 to 20-year right now. And I just spoke to a client the other night, $110,000 over the time period from his,
Wow.
I think the next 7 years is how his calculation came out. He's saving $110,000 in interest payments. It's fantastic.
Now, as far as him, generally speaking, you know, as a homeowner, I care about, okay, is my payment going to be the same? So is it relatively, if I go from a 30 to a 20, and of course I know this is very general, you have to have more
Fine.
specifics,
Yeah.
you know, but is it going to be for the one point, is it going to be basically about the same? Or if I switch from 30 to 20
Great,
years?
great question. A lot of people ask that question, and it even comes up to the 15-year. Everyone wants to pay their mortgage off faster, right? So the 15 year is the bigger question. They sometimes forget there isn't even a 20-year fix. There is, but both for the 20-year and the 15-year, reducing your term from let's even say the 30 to the 20 and going from 4.25 down to 3.25. Using that as an example, going from that 30 to that 20-year, your payment is going to go up. It's not going to be the same. How much could it go up? $150, $200, 2.25 in that range. But then you have to calculate the interest savings, right? So once you start calculating the interest savings and putting that into play and what you would have paid over the time period, like I said, the individual I just refinancing, he's closing this upcoming Wednesday. He's saving $110,000 in interest payments by paying, I think it was like $208 more a month. And he was happy with it. He's,
Right. You look at the long term.
Yeah.
Right. I mean, that's one of the things that I did with my own mortgage. I was already almost 10 years into it, and I did not want to go. You know, everybody thinks, oh, wow, I just lowered my payment, but you just added another 10 years on top of the 10 years. It's like a 40-year mortgage.
Yeah, right,
So
exactly.
that's why it's a great idea. Your great advice to go, if you can go from 30 to 20 and afford that extra 150, you
It's
know.
it's a no-brainer.
Right, right. It's great. It's great advice.
Yeah.
You
Whatever.
know, and things are still in place as far as first-time home buyers, as
Yeah.
far as that
Let's talk
low, the
about that. Yeah.
3.5%, I believe, is the
A little bit
minimum.
less. They still have. I mean, so first-time home buyers, whoever's out there watching, you could still do as little as 3% down
Wow. Okay.
conventional loan and 3.5% down with FHA. So the down payment hasn't gone away. They're still sticking to that low down payment, which is fantastic. It still helps the first-time home buyers to become homeowners with not that much money out of their pocket. So those programs are still out there. There's reduced PMI for those first-time home buyers. If you qualify, there is a qualification to it, but there is some
Okay.
reduced PMI, which PMI is private mortgage insurance. For those that don't know, it's an
Okay. Thank you.
mortgage payment for those individuals that don't put 20% down. So everyone thinks you have to put 20% down, Mike. Not the case. You could
No.
do as little as 3%, as I'm mentioning, 10%, 15%, everybody. But you have this additional PMI payment, this additional insurance payment on top of your normal mortgage payment. So for first-time home buyers, there are still some programs out there that are helpful.
Now, is the program still in place that as soon as your equity reaches 80%, the PMI automatically drops off?
Okay, great question. I'll start with the government loans. The government loans, that doesn't go into play. They have different qualifications. So specifically, I'm going to answer this question for a conventional loan. So conventional loans, if you purchase the property with, let's say, 10% down, hypothetically speaking, and your mortgage balance got to 78% loan to value, that's the rule of thumb. It's actually weird if you purchase with 20% down, you don't have PMI, but when you looking to remove a PMI, the lending institutions require 78% loan to value, so that's 22% equity. The PMI automatically drops off. So you're right. Just wanted to tweak what the exact guideline was, but that still goes on. That's still allowed. That hasn't gone away.
But the government loans, you're saying, is different.
Way different. Yeah. So the government loans are different. So FHA specifically has their rule. It's a line in the sand, and it's either you're on one side or the other, right? So FHA, if you put down less than 10%, you have PMI for the life of the loan,
Wow.
for the life of the loan. So a 30-year fixed, all 30 years. If you put down 10% or more, and it doesn't matter if you put down 20 or 30 or 40, and there are some individuals that their credit score requires them to go FHA, we're putting such a large down payment down. So don't be surprised if you're saying that out there, well, why would you go FHA if you have 30% to put down? It happens, everybody. So, but if 10% or more down, your PMI is on your loan for 11 years. And after the 11th year, that's when it gets removed. So it doesn't matter the size of the down payment. So 10% or less down, life of loan, 10% or more down, 11 years, and it comes off.
So you would kind of encourage first-time home buyers to try and make that 10% or more if they could.
If they were going FHA and they had the extra cash flow to do the 10% down and cover the closing costs, absolutely. It makes more sense to do it that way because there's a light at the end of the tunnel. But at the same token, I deal with a lot of consumers that just really, in New York is pricey, let's call it what it is, and they just can't come up with the extra, the extra money. And that's fine. That's not a problem. Don't be scared of home ownership because you have to pay this PMI payment.
Right, because it's really not that much, right?
It's not
Correct?
that much, right? So don't be scared of it. So that's my advice to everybody.
All right. So, Mike, if people have any questions and want advice from you, what's the best way to reach out and get in touch with you?
Sure. Yeah. Thank you, Mike. So again, my name is Mike Scarimbolo. I work with First Home Bank. The best way to get in touch with me is either via email or my work phone number. And I'll even give my cell phone number at this time because right now no one's at work. So my email is mscarimbolo@firsthomebank.com. So that's MSCARIMBOLO at firsthomebank.com. And my cell phone, 917-699-1879. 917-699-1879 is my cell. Best way to get in touch with me right now during COVID-19 because we're all working from home. And Mike, I just want to say to you and all your viewers out there, First Home Bank is funding loans. The lending institution, at least with us, we haven't stopped funding loans. Our
Great.
underwriters and openers and closers and processing team, they're all working remotely, yes, but we have been, since this started, continuously closing loans on a weekly basis, and nothing has stopped us from closing. So that's the positive news. Everyone thinks lending has stopped. It hasn't stopped with First Home Bank. It hasn't stopped with me and my staff.
Great, Mike.
My clients were able to to get what they need.
I just wanted to clarify that even though you spoke a lot about New York City and made it New York City specific, you are licensed for all 50 states.
Yes, Michael, thank you. So I'm a licensed loan originator, branch manager of the Staten Island branch specifically, but I am licensed in all 50 states. So I thank you for allowing me to say that. Yes.
Yeah. Okay. Well, again, thank you very much for the interview, Mike. I hope everybody out there got great information here. If you need any help or advice, real estate advice, please reach out to me. Any mortgage advice, please reach out to Mike Scarimbolo. And I'll end this video with Mike's information. Thanks, everybody.
Bye, everybody.